is up, everybody? Welcome back. This is the Fresh Finance Podcast. My name is Thomas Elms. I've got my co-host here, Kyle Ryan. Today, we are going to be a little impromptu. We're kind of going a little off the cuff. This is going to be a fairly kind of opinionated episode where Kyle and I are just going to honestly talk about the markets, talk about what's going on. The four things that we really wanted to just kind of get our opinions kind of out of our mouths on today are just where the market is at, talk about interest rates, talk about inflation, and lastly, kind of talk about fixed income, the bond portion of your portfolio. And, Kyle, this is a unique year. I heard something the other day that I think reigns true, especially right now, is every bear market is different. Not saying that this is a recession because we aren't there yet. But every bear market is different, and I think that one of the things people do is they try and categorize or factualize different economic situations and scenarios that have happened in the past, and they try and relate it to, new bear market conditions. And, I'm pretty sure that there's a bunch of different, analogies getting made today, but honestly, we're just getting attacked from all fronts. We're seeing a multiples, conversation on the stock market side. We're seeing inflation hitting everybody. The number that came out a couple weeks ago, was 8.6. That's not the number that we wanted to see. Rates just got hiked another 75 basis points, and any sort of current fixed income positions just getting hammered. Would love just kind of your quick take on some of those things, primarily just on the market side, maybe to start off and just kind of see where you're at with everything.
Yeah, I don't know anyone who's positive this year, unless
they're all in energy.
Unless they're all in energy or maybe commodities or something. But I'd like to start off with, a recession, because this is something I've been talking a lot about with clients, something you hear a lot of concerns with, the hard R word, right? Mm-hmm. Recession, it's what everyone's afraid of. We could very well be in a recession today. We had a negative, what is a recession? A recession is 2 quarters of negative GDP growth. Yeah. So we just had a print come out, was that in May, of a negative GDP growth. And then, the next one comes out, I believe, in August. And we'll know at that time whether or not we're in a recession. So we very well could be in one today. The thing about recessions is you're looking in the rearview mirror, right? So 2020 was a flash crash. We were in a recession. By the time we were out of the recession, the market was up 20%.
Yep.
Right. So, when, what they always say, buy when fear is at its highest, sell when greed is at its highest. Right. So we're at a time where consumer sentiment is at its lowest. And recession fears are at their highest. Inflation just surprised and peaked. That came out, and that was just devastating to the markets. Mm-hmm. We saw a 0.75% hike from the Fed. Some guidance came out for once, saying what they might do next month. So, we might get 0.5% or 0.75%, given the information we have. So a lot of things are moving, right? You can't just say, oh, we have high inflations, what they do in the 80s. Right. You made a really good point. We're trying to look at historical references for today's performance. Can't really do that, right? And it's never perfect, but you can get insight about how things performed and what did better, what asset classes, what sectors really did well. So, who really knows? Oh, I have a surprise for you, Thomas. I actually didn't tell you about this offline. Right?
Uh-oh.
I have a crystal ball.
Oh, he's got the crystal ball.
I got a crystal ball. For people not looking, I have a crystal ball. And even after purchasing this, I can tell you, I got no idea what's going to happen.
Oh my goodness. I need to get me one of those. Oh man. If you're just listening on the podcast, Kyle just whipped out a full-size crystal ball. That's incredible, man.
Whenever you need an answer and you really want a sure one, compliance listening, I'm kidding, but, I got a crystal ball now. So, of course, Thomas and I, we don't know what's going to happen in the next 3 to 6 months. Historically speaking, markets come back, but, we just want to really talk about, again, Thomas, I'll turn it over to you. We just heard from the Fed, give me your take on, what they've been doing and what you kind of see. And I know, again, you don't have the crystal ball, but what do you really see in, the short term, some choppy weather, are there any catalysts that can really turn this thing around for us?
And that's the intriguing part is catalysts. I'm not sure because, you think about the Fed guidance we just got. I mean, yeah, we got a 75 basis point hike, which was more than we expected in March, at least. It sounded like everybody and their brother knew we were going to get 75 basis points, all week this week.
Yep.
But the guidance on inflation, I think was super positive in my opinion. That they were projecting, end of 2022, we were going to be CPI at about 5.5%. End of 2023, hovering back around, 2.5 to 3%. That to me means we've peaked on inflation, right?
Yep.
That's a positive indicator for me. Yet, today is what, June 16th, and we're down 4% on the NASDAQ right now. And just kind of like updated numbers as of today. I mean, S&P's down 24, NASDAQ's down 33. The Dow's down right about 18 and some change. And it's just that conversation of how is the market going to react, even though a lot of these things are baked in, right? Because everybody's saying that the market has already priced in 200 basis points in hikes, right? So if we do another 75, we're there. In July, so it's just that conversation of, what is going to be the catalyst? Because there are some unknowns out there right now, and unknowns are what drives bear markets, which I think is super important to understand, because a lot of people were kind of at the beginning of the year saying like, oh, this is going to drive down the economy. This is going to drive down the market. And it's the key to this understanding is if it's a known, the market's already priced it in for the most part, right? So like COVID was the big unknown. That's why we saw 10,000 Dow points just see you later in a month, is it was a huge unknown. How is this going to affect the economy? How is this going to affect the world? Production, service, consumption. And, I think that's the big case there is we just essentially need to wait and see how the market is going to be affected by or repriced by inflation numbers, hopefully coming down as these rate hikes go on. And where just we see the remaining part of the market go, because here's the thing too, is as far as earnings go, for the most part, financial health and earnings throughout this entire year have been very positive. I mean, probably 70 to 80% of corporate earnings have been, for the most part, either one of two or two of two on the earnings per share on the revenues. They've been beating consistently. And I think honestly, the biggest thing right now is guidance hasn't been very good. That's probably been one of the major drawdowns, is corporate guidance hasn't been very good. But from a numbers perspective, most companies financially look pretty good right now. I also think multiples have dropped down a bunch because prices have just gotten slashed so much. I think, that's a positive, from a way up perspective. But one of the things I did want to hit on was the interest rate conversation. And I think that there's kind of one key piece that a lot of people don't necessarily understand from a Fed rate hike conversation. I got my air quotes, if just use my air quotes if you're just listening on the podcast side of things. But the way that rate hikes actually happen is if we see a 75 basis point hike like we just saw on Wednesday, what's essentially happening is they're not raising interest rates. There's air quotes again. What they're actually doing is they're raising what's called the Fed funds rate, which Kyle, I know you know this, but the Fed funds rate is essentially just the overnight borrowing process between banks and between corporations. And when they raise the rates for that overnight borrowing, that in turn raises rates for things that affect consumers, right? Things like mortgages, things like car loans, things like just personal private loans, right? And then those increased Fed funds rates also affect the rates issued to corporations, publicly traded companies. And so it's almost kind of like a domino effect. They raise rates on the Fed funds rate, and then that Fed funds rate will then be a catalyst to raising additional rates to consumers. I think that's just kind of a really important conversation, because right now, I mean, we were just looking at it, the average 30-year mortgage that's going out right now is hitting 6%. I mean, that's
it's ridiculous
for the 20s and even the late teens of the 2000s. That's an insane number. Thinking about, mid-COVID, people were refining for 2.25% if you had good credit.
Just this year.
It's insane.
Yeah. Just in January, we were getting those rates.
And then just kind of looking, on some quick numbers. If I just pull this up real quick numbers on CPI as of the May number that came out last week. I mean, meat, poultry, and fish and eggs prices up 14%. Energy. So energy and, things to kind of keep the lights on at the house up 34%, gas up 48%, new vehicle purchases up 12%. So that's a bit of the chip shortage as well. And airline airfare, actually one of the biggest, inflated numbers right now, up almost 38% for airline prices. So there's a lot of things hitting people. And I'm hearing conversations from people that I didn't think I'd be hearing conversations from, about how much inflation is actually affecting them right now. And normally when you get to that point, you're at a peak. And so that's kind of my positive outlook on the inflation side of things.
Yeah, I mean, most people's gauge of inflation is the one everyone can see because it's everywhere. Gas prices. It's the most familiar one. It's the one that hits home. When you come home from the grocery store, holy hell, did I just spend $80 more than I normally do on a weekly basis? It hits people the hardest. And who does it hit the hardest? Lower income individuals, right? TSA, you just mentioned flights going up. TSA, I mean, people are flying again. Business travel is the only thing that's down. People are domestically flying, for vacations and whatnot.
Yeah.
Just the same way they are. So how do prices stay this high? Demand is still strong. Demand is still there. People are paying it. $5 at the gas, it wouldn't be there if no one was lining up at the tanks, at the pumps. People are still paying it. So when and you made a lot of great points. Why do they raise interest rates and how does it affect you? They raise interest rates. One big thing that is in the Fed's tool, the reason they raise interest rates is to curb demand. They know people are out there buying left and right. Home prices have recently stopped going up. They started to seem to have hit their peak and started going down. Who knows? Whip out the crystal ball and it'll tell me. But so things demand is slowing down, right? So an increase in interest rates, you're going to affect things that affect inflation, right? Wage growth going higher in a tight labor market. Let me go back to this example. I remember I said this in a previous episode. The economy is like a fire. Right? When it burns too hot, when you dump money in it, like we did throughout the pandemic, it gets too hot. The fire grows too big. So the Fed, what they do is they can control interest rates. They can turn on the hose, raise interest rates, slow demand. The fire naturally kind of decreases, right? So, and vice versa with decreasing interest rates. We went into the pandemic, there was no economic activity. They wanted to spur growth. Lowered interest rates. People can spend more because it costs them less, right? So, it's just a simple tool that the Fed will use. And honestly, the big thing this year, why it continues to just surprise and go down the market is because you really don't fight the Fed. You have to really know the Fed's intent. And the Fed is data dependent, right? The data that they receive, they interpret and they make decisions with. Because of that, they're not forward looking, right? They're looking at today. They're not looking at what we could be in the future. They're focused on data today. So were they a little bit late to raising interest rates? Yes, they may have been because they're looking at data and it didn't start really hitting the system. So now they're trying to play catch up. We didn't think they'd have to play catch up this quick until we got the highest inflation print we got from May, right? So now all of a sudden they have to pivot and in our opinion, they are willing to induce a recession. They're really ready to stomp on this thing, stop economic growth, spur demand in order to get inflation in check. He's got a Paul Volcker 80s type of situation on him.
Yeah.
He really got, Jerome Powell's and the Fed, they've really got a tough job. And, they think they're going to get over the hump with inflation the next year based on their projections, which would be wonderful because it's killing everyone. But again, who knows?
Yeah, for sure. There's a ton of truth to that. I appreciate the Volcker analogy because I think that is a place where, we can kind of, reiterate what past like historical situations have looked like. I totally agree. And kind of moving over to the fixed income side, this has been really in our team's perspective. This has kind of been like the biggest kicker of the year is fixed income because for so long it's been just a great place to park cash, to kind of, if you're in retirement to have your, 1 to 3 years of, next retirement spending, just park there. You get a little bit of yield. It's not going to move, very stable. And then we get to this point where inflation hits, we raise rates really quickly, and the yield just tumbles, which in a situation where in most bear markets, your fixed income piece of your portfolio is kind of going to be your stronghold. This was a place where it was doing worse than some value positions to a degree. And I think that's just been the biggest kicker. But, our team's thought process, and we're even echoing this on like the fixed annuity side of things, is we're seeing rates start to increase in new offerings. because it takes, fixed income or annuity, companies about 3 to 6 months, maybe even 7 to 9 months to kind of basically get back on track to where new rates and new issuings are coming into play. And, we've got a pretty positive outlook on where we think fixed income will be, at least in the midterm, next probably 1 to 5 years, is income's going to have high yield. And, it's just a matter of time that those things will kind of level off, which provides a little bit of positivity, at least in my opinion, on the fixed income side, because it's just gotten decimated this year. I mean,
It really has.
Bloomberg Barclays bond index is down over 10% year to date right now. That's what I'm hearing from my team and some of the other advisors that I network with is this is probably like a, and obviously no guarantees here, but this is probably a once in your career event, from a bond returns perspective, at least just in the time frame, like how quickly it went down. So we have a decently positive outlook on the fixed income sector as well.
Yeah, it's kind of the whole thing, right? So when you have really high interest rates, what's going to get hurt is your long duration assets.
Yep.
Those are stocks. Those are like the growth stocks, right? The technology stocks that are getting, you mentioned the NASDAQ is the one that's the index that's down the most. It's because those are the companies that, they're growing at such an incredible clip, but they need a long time to realize those earnings and to grow into what the market considers them to be, yep. Right? Bonds are the same way. Some bonds are fixed for 30 years. Those ones are getting absolutely hammered compared to the ones that are 2 years, right? Because inflation expectations are much worse the further you go down the curve, right? So, everything had to get repriced. And you make a really good point, so bonds were on like a 40-year bull run where all they could do, except for a couple of years here and there, was go up. Well, you had bonds and stocks get really extended, so again, I'll go with the seesaw analogy I made in a previous episode. Bonds behave like a seesaw. Their price, which had been going up and up and up in the last decade plus, meant that their yield was lowering. You didn't care because you got capital appreciation. Now we're at a point where you lose 10% bond in NAV, in actual value, but their yields have skyrocketed. Yeah. So it's been a really painful time to be invested in bonds. You probably wiped out almost 3 years of gains. But now on a look forward basis, bonds are very reasonably priced. They're offering very attractive yields, like you mentioned. So it's a short-term pain that we're all facing. No one's safe from it. But honestly, the market needed this correction. It really needed it to reposition itself. We're not saying it's at the bottom here. There could still be more pain in the next 3 to 6 months as we wait for that catalyst that Thomas and I mentioned before. Who knows what it is? But until we have that spark, you mentioned it before. Again, uncertainty breeds fear, and there's still a lot of uncertainty out there. And until we get some real stability and some real answers for the direction this economy is going to go, I can still see choppy waters in both the stock and bond market until that catalyst hits.
Yeah, for sure. And honestly, this is the time where you really want to be telling yourself and just reinforcing the idea of share purchasing and just general ownership, right? Is regardless of the price, you want to acquire more and more shares of the things that you perceive as short, mid, and long-term value, right? Short being, especially if you're in that retirement phase, short being the things that are going to take care of, your expenses for the next 1 to 3 years, mid being, any sort of expenses the next 5 to 7 years, and long is anything 7+ years, 10+ years, is you want to be just continuously purchasing things that you think are of value and will grow, just acquiring more and more shares. That's just kind of the thing that you got to tell yourself right now. And can we, this is kind of a random one as well, Kyle, I'm just kind of throwing at you, but can we have a very general crypto conversation, or is that going to be a no-go?
I don't know. We can go for it.
Let's see. Let's do it at the end of the episode. And if you don't, if it cuts off right here, then we couldn't say it. But one of the most interesting things right now that I saw on Tuesday was, when you think about it, the dollar index year to date is up double digits. It's up like 11% year to date.
Yeah, you're not wrong, right? So I mean, the word for it is we're in a risk off market,
Mm-hmm.
right? So what were the first, when the market's going down, you have to start liquidating things. You start selling things that are down the least, right? So because you hope it comes back. So you really saw this max exodus of quality companies in the beginning of the year when
Mm-hmm.
things started to unfold. And as we got further and further along, the floor kind of gave out for some of these lower quality names. And when you don't have earnings, when you don't have fundamentals to back you up.
And honestly, the last thing I was going to say is it's just kind of more sympathetic to the advisors out there. This is the hardest part of our job. And I think that some people don't necessarily like take into this perspective, but obviously our prime goal as advisors is to have people who invest money with us, that their accounts go up, right? We can help them build wealth based off of, the expertise and the recommendations that we make. And just the absolute truth is the fact that it's never always going to be up, and this is that example of the fact that it's not always going to be up. And this is a tough market for everybody, clients and advisors. My accounts are down. I know your accounts are down. Everybody's accounts are down, and it's not fun, but just continuously working through that, being disciplined in your strategy and your behavior, and just navigating through it with, the professional that you utilize, I think is just the most important factor there. And really just kind of, in markets like this, focus on your planning, make sure your beneficiaries are up to date, make sure your estate planning is correct, make sure you have enough insurance coverage, focus on your budget, see if there's ways where you can maximize to continuously make contributions to these accounts, to kind of get yourself away from the portfolio values and the returns. I think that's a good way to kind of keep your mind off of it, and don't watch the news all day, because that'll crush you.
The news will kill you. Yeah, no, this is a difficult time, because you never want to hear a client be upset. You never want a client to lose money, but this is really when, the behavioral finance and the value, as you mentioned, of a financial advisor really, peaks, because one, we have to keep people invested in the market and not let short-term pain interrupt your long-term plan, right? You always say, know the story of why you own something.
Mm-hmm.
So you just, again, you always want to work with someone who you trust, who you can communicate with, they can talk you through these times. That's most of what I'm doing today, is talking to clients, letting them know what's going on. And so we can make informed decisions together. And it's not just because Kyle said so, there's actual reasons, there's fundamental things that can make this thing turn around, and fundamental reasons to stay for the long haul. It's just difficult, but being able to talk yourself through it, not making emotional decisions, rebalance on whatever schedule you normally rebalance at, because if you didn't rebalance at the end of last year, you're still overweight growth, right? And then this year just make sure you're doing consistent rebalancing, looking at your portfolio, not emotionally, right? Because you don't want to go, at the end of May, we had a huge run in the market. Not the time to go jumping in because the market's jumping up, right? You don't react on headlines, we react on fundamentals. Yeah. So that's always what we say.
For sure. Well, that's it for me, man. Is that it for you?
Yeah. Just wanted to give everyone a quick update on what the heck means when they're raising 0.75% out of the blue and they got another one down the pike. So yeah, here it comes. I brought the crystal ball today.
I love it. Well, hey, always a pleasure. Appreciate it, Kyle. Thank you to everybody watching. Thank you to everybody listening. If you're doing a little bit of both, really appreciate it. And we're looking forward to next week's episode.
All right. We'll catch you.
Thanks, guys.